sort of things we'll be looking at. What is a trust? The roles, the key parties involved in trust, advantages, disadvantages, different types of trusts, some of the key issues about establishing a trust, and some tax issues to do with trusts as well. And then there'll be just some issues at the end. So we're trying to cover give you a bit of a broad understanding, cover a number of different concepts in relation to trusts. Trusts can be a very powerful tool. Trusts have some significant advantages from an asset protection point of view and from a tax point of view. But trust law is complex. Trust law is governed by your common law, your case law. It's governed by legislation, the Trustee Act. Tax law has a big impact. The taxation of trusts is very complex, and anybody who knows anything in this area and has dealt with it in the last couple of years, where we've had Bamford, the High Court case in Bamford, and the new laws relating to streaming of income and significant individuals, all that sort of stuff, realise just how complex this area is. So if it's taken the High Court and the ATO and everybody 80 years or more to try and figure certain things out, you can just see how complex it is. So it's a very complex area. But having some knowledge is good because it can be very advantageous, obviously, for you and your clients, but also just be wary that it is complex, and there are times when you do need to get outside advice. Which is the tip there. Well, that worked out, Tommy, didn't it? Also, there's a warning there, Part 4A. Part 4A is the anti-avoidance provision, the general anti-avoidance provision in the Tax Act, which gives the Commissioner power, if he thinks something is being done for the sole or dominant purpose to get a tax benefit, then he can actually attack the arrangement. So it might look all right, but he then has this general power, which gives him great powers to investigate, look at deeds and do the various things. So just overarching everything, we can do a lot of things. We can do a lot of things to minimise tax using trusts, but when you get to right on the cutting edge, sometimes people call it the cutting edge, others call it blatant tax avoidance, others call different things, just be wary that the Part 4A can apply. The other thing we need to be wary of course, is as advisors in this area, just, are we giving tax advice? Are we giving financial planning advice? We all know that there's this big blurry line between accountants giving financial planning advice and financial planners giving tax advice, and who gives what, etc. And that's all being things sorted out somewhere, hopefully. In any event, they've asked me to mention what the Tax Agents Manual, which is all about the Tax Agent Services Act and those sorts of issues. All right, what is a trust? What are we actually dealing with? A trust, unlike a company, is not a separate legal entity. There is no such thing as a trust. We talk about trusts like the trust derives income, the trust buys property, but there is no legal entity as a trust. A trust is simply a relationship. The legal entity is the trustee. The trustee is the one that legally owns the assets of the trust. And it's a relationship between the trustee and the trustee holding these assets on behalf of other people, of others being the beneficiaries. And that is the relationship. It's the relationship between the trustee who holds what we call the legal ownership in the property, and the beneficiaries who they hold on their behalf, who they have the beneficial ownership or beneficial interest or equitable interest in the property. So it's a relationship. And to have a trust, as you can see on the overhead, there are 4 elements. You have a trustee. You need to have property. The trustee must hold some property on trust. There must be a beneficiary who they're holding the property on trust for, and there must be a clear intention to create legal relations, to have this relationship between the two. And without any one of those 4 elements, you do not have a trust. So that's the important thing about having a trust. It is a relationship. Though I will talk today as if a trust is a separate legal entity. Trust logic, there's a trust tax return. They get treated as if they're a separate legal entity by the tax office as well, and the tax law. So, and we'll talk it like that, but just be wary, technically it is a separate relationship. And that's why when I make some comments about trustees and who should be trustees, that is vitally important. Be wary also, to have a trust, the trustee and the beneficiary must be different. And you'll notice in that sort of last paragraph on the overhead, if you've got a trustee and there's only one beneficiary who is the trustee, there is no trust. I cannot hold an asset on trust for myself. I can be one of a number of beneficiaries and I can still be the trustee. That's not a problem. I can be the trustee of my family discretionary trust, of which I'm a beneficiary and my family and anybody else's. That's not a problem. But I just can't be the sole trustee. And sometimes that can happen where you might have a trust might be set up where I'm holding an asset on trust for myself and 3 other people for some reason, say a property development project or something like that. For whatever reason, we do this project and we build 4 units, the idea being we're each going to get a unit and the other 3 get their units. So I'm left, they've got their units, they've disappeared, I'm left with the last unit and I'm the only beneficiary in that trust, then there is no trust anymore. Okay, the key parties involved in a trust is the trustee, obviously one of the main key parties. They're the legal owner of the asset, and as the owner of the asset, they deal with it. They can sell it, they can earn income from it, they do what they're the ones that run the trust day to day, the trustee. Please understand, today we'll be talking, and I'll be mainly talking about what I call a discretionary trust, a family discretionary trust. There are lots of different types of trusts. There's unit trusts, hybrid trusts. Other trusts mentioned here, for example, a person dies, then as soon as a person dies, they don't own the assets anymore. They're dead. So who owns the assets? All the assets of that individual now go into a trust, essentially referred to as the deceased estate. That is a form of trust. And the trustee of the deceased estate initially will be the executor of the will, or often the executor is normally the executor and trustee of the deceased estate. Sometimes they're separate. So there's a trust automatically forms at that point in time. You become bankrupt. What happens? A trustee in bankruptcy is appointed. So your assets now vest in the trustee in bankruptcy. So there are other circumstances when a trust arises. But we'll be talking about your normal trust where we set one up purposefully for a client to invest or for carrying on a business type purposes. The trustee can be an individual or it can be a company. And essentially, the question that's often asked is, do I have a company or do I have an individual? Which is best? Remember, the trustee is personally liable. They are the legal owner. So if they're running a business in a trust, who's going to get sued? The trustee gets sued. And then there's all sorts of laws and rights. They say, well, hey, I'm acting in my capacity as trustee and I can get the assets of the trust, can pay the creditors, etc. But they are the one who personally gets sued. So best advice is to have a corporate trustee. If you have a company as trustee, just a $2 company, or these days it's a $1 company, then your personal assets are not on the line. Even if you are an individual as a trustee and you get sued in your capacity as trustee, whilst you would argue that my personal assets are safe because I'm acting in my capacity as trustee, etc., there are times when your personal assets could possibly be at risk. So best practice is have a corporate trustee, and then you get double protection. And why I say you get double protection is that if the trust business fails and the trust is sued, then the assets of the trust are at risk. And if you are a beneficiary of that trust, of a discretionary trust, as a beneficiary, you have no obligations to the trust. So if the trust goes under, you don't have to contribute anything. Your assets are protected. And I call it double protection because in a discretionary trust, if I'm running my own business in my own name and I get sued, say, for professional negligence as a lawyer, then any assets that are in the trust, they are protected because I don't own them. As a beneficiary in trust, I don't own any of the assets in the trust. And anything in the trust, anybody who sues me personally cannot get access. So you get protection at both levels in that case. Having a company as a trustee of the trust limits the right of any creditor to sue the company and any assets that the company owns or the assets of the trust. So therefore the company owns no assets in its own right, just the trust does, then you've got this asset protection. And that's why it's best. However, having a company as a trustee costs money. You've got to set up the company and then you've got the annual asset fee, etc. So my advice, or the best advice, and we're all probably advisors in the room, you advise your clients, best practice, have a corporate trustee, but my personal view is you don't always need one. For example, I have a trust. My trust invests in shares, it's just an investment trust, invests in shares in the stock market. Now, I cannot work out when, or I don't believe my trust will ever be sued, so the risk of my trust having any, hopefully, financial difficulties or any being sued is remote, so I'm the individual trustee. I don't think it's going to cause me a concern. But if my trust was running a business, then I would certainly have a corporate trustee. So you work out, what's your risk profile, or the chances of the trust being sued? If you are the individual trustee of a trust and it is sued, then remember the onus of proof is on you to be able to ascertain which assets that you own are being held on behalf of the trust and which assets you own belong to you and therefore hopefully are not available for the creditors of the trust. Because as a creditor of the trust, all they'll be doing, they'll just do a legal search and they'll say, oh, there's a title search. We see you own shares in these companies, you own these properties, etc. And you'll have to go, oh, no, I own that property in my own right. That's my own property. And then you have to prove it, etc. So it stops those arguments. The other question I'm often asked is, if I have two trusts, can I have the same company as trustee of both trusts to save me some money? Again, best answer is have two different corporate trustees. If Trust 1 gets sued, then you've got the issue is, does that mean the assets in Trust 2 are at risk? There's a couple of different cases around, fairly old cases now. One said, yes, the other assets, the other trusts are at risk. The other one said, no, they're not. My personal view is I think if you can, as long as you can show them the assets in which trust they belong, then only the assets in the trust that's gone under are at risk, in my view. But who wants the fight? Who wants the argument? Who wants to be able to go around having to prove which assets belong to which trust and whether the case law, which of those cases really holds up these days? Beneficiaries. There are other key parties in the trust. So we have the trustee holds property for the benefit of the beneficiaries. Now, I'm going to use the term beneficiaries. Technically, in a discretionary trust, and we'll talk about some different types of trust, but a discretionary trust I'm assuming most people are familiar with, and that's where under a discretionary trust, the trustee has a discretion to distribute. It's up to the trustee who to distribute the income of the trust to, and it's up to the trustee who to distribute the capital or the trust fund, the capital of the trust to, the actual assets of the trust to. So the trustee's got these total discretions. In that case, the beneficiaries don't own anything in the trust. They don't own the trust property. Yes, the trustee's holding the assets on trust for them, but because the trustee has a discretion, they may get nothing from the trust at all. And that's fine. The trustee's got that power and they don't have to give anything to any particular beneficiaries. In those sorts of cases, where you don't actually own anything in the trust, these beneficiaries of these discretionary trusts really are technically called objects. So you might see the term objects of a trust. They are just the people named in the deed who might be able to benefit, the ones who can possibly benefit under the terms of the trust deed if the trustee decides to distribute in their favour. Now, if the trustee says, hey, I resolve to distribute the income to X, once the trustee's done that, then X, and let's say it's $10, X is now a beneficiary because they now have a right to demand payment of the $10. So that's when they become a beneficiary. Unlike, say, a fixed trust where I say, hey, I'm going to hold this on trust for all of you. Just you, no one else, no discretions, this is you. And any income earned on this clicker goes to you guys proportionally. Then in that case, you do have an interest in this. You are beneficiaries because we know on the ending of the trust you'll each divide that up and each get a little small portion, not going to be much of it for you, and the income will go proportionally to all of you. A unit trust is like another case. A unit trust where if you buy units in a unit trust you have a fixed right to the assets and the income of the trust. In that case you are beneficiaries. Objects is more for a discretionary trust. Beneficiaries can be can be individuals, can be companies. Often beneficiaries in the good old days, and I'll talk about this a bit later, we had companies were beneficiaries so that you could distribute income to the companies so they paid tax on it at the corporate rate of tax, where the individuals had high rates of tax themselves. So it was a way of minimising tax. Things have changed. The appointor, another important person in a trust. A trust is a relationship. The owner of the property is the trustee. It is the trustee that decides who gets the income, who has the discretion to distribute the income to anybody, who gets the capital in a discretionary trust. So you would think the controller, the ultimate control of the trust is the trustee, and the answer is no. The most important person in a trust is the appointor, because it's the appointor whose role is has the power to remove and appoint the trustee. And if you've got the power to remove and appoint the trustee, I can remove a company controlled by my wife as trustee of the trust. I appoint my own company, which I'm controller of, and now I get control of the trust. And whoever controls the trust controls the assets and the funds, the income and everything else. So the appointor is really the ultimate controller. Some trust deeds may not have an appointor, and it might be the trustee itself who gets the power to appoint and remove trustees. So whoever's got that power, that's the person who you want to make sure if you're what I'll call colloquially the owner of the trust, you want to make sure you have that power or that control. Please be wary of the appointor when you're giving advices on trust or looking at trustees. A client might come to you and say, look, I'm going through the separation, looking for some advice, etc. If they've got a trust, have a look at their appointor and see what happens. Because I've seen cases where we've got mum and dad. The deed says, okay, dad's the appointor. On his death, it goes to mum if she's still alive, etc. Now, of course, mum and dad, they get divorced. It's a bitter divorce. Somewhere down the track, dad dies. All of a sudden, and he's got, as a result of the divorce, dad's still kept control of the trust and all its assets. He dies. Next thing you know, just purely by that clause, no one's changed it. She becomes the appointor and can get control of the trust. So you've got to look out for these things. Some of these things just crop up once we get divorces and separations. Normally, in our standard, normal family discretionary trust, if I'm setting up a trust for my family, I'll be the appointor. I'll make sure I'm the director on the board of the trustee company so I can control the trust. It might be me and my wife. I don't know. It depends on the circumstances, etc. So normally, most people we deal with, they're dealing in their family discretionary trust. They want to own it and control it, and that's fine. That's how it should be done. As of recently, we had a High Court decision in the Bamford case, as I'm sure many of you probably have heard of it or read about it. As a result of the Bamford case, a lot of trust deeds have been amended in recent times. As a result of the tax laws in relation to trust being amended about a year or so ago, we had a lot of trust deeds have been reviewed and amended. What that has brought home to me, because I've done a lot of reviewing and amending of trust deeds, is a lot of clients have rung me and said, well, we're telling our clients got to amend the deeds. That's great. Yep, fix them all up. That's wonderful. And then they come and say, we can't find the deed. It is so important to have, if you can't find the original, that's bad. If you can't find a copy of the original, that's terrible. If you can't find any evidence that there's even a trust exists, or what the terms of the trust might be, that's an absolute nightmare. And you've got this real problem. If you've lost the deed and you've got nothing left, then there's not a lot that can be done. Okay? If you don't have the deed, you can rely on the powers in the Trustee Act. Without the deed, what powers does the trustee have? Well, the Trustee Act sets out some powers. And that's fine. It sets a lot of investment powers, so that probably gets you by in some cases. Unfortunately, the Trustee Act does not give the trustee the power to carry on a business. So if you've got a trust which is carrying on a business, that's a pretty handy power to have. So that's a problem. What can you do? Well, there's a number of things you possibly can do. If you've got a copy of the deed, that's fine. Then you can just do another deed and saying, look, all the parties agree this is the trust and here's the terms and here's the copy of it, etc. But if you've got absolutely nothing, then what do? You can try and do things called deeds of confirmation or deed of variation and those sorts of things. But in all honesty, whether they actually work legally, if you go into a court of law, that's highly questionable. In a lot of cases, it just might be the practical answer. You might be just saying, hey, we just need this so we can just produce it to a bank and hopefully the bank will allow it, or for somebody else, etc., for whatever reason. So from a practical point of view, often they'll work, but legally, technically, they may not. So it's really important, don't lose those deeds. And as an advisor to clients, then, and particularly if you're advising clients to set up or helping them establish trust, then it'd be worth you keeping a copy of the signed deed and just in your file so that, or scan it even and put it, so you don't have to store it. So at least if it does get lost, then the worst case, if your clients lose it, which they happen to do, then they, at the end of the day, at least there's a copy there. We can do another deed, attach this one to it, and that will suffice for the future. Basics of the trust. What a trust, set it all up. What are the major uses of a trust? Asset protection. Very good asset protection. I've described that before, the two-tier structure with a discretionary trust. With a unit trust, you still get asset protection, but it's not, you don't get the double one, because in a unit trust, you've got your assets in the unit trust. If the unit trust is sued, then the personal assets of the individual beneficiaries, the unit holders, they're all protected. You can't, as a unit holder, you've got no obligation to contribute more money to the unit trust unless your units are unpaid or partly paid. But if the unit holder is sued, if they get into financial difficulty, then of course one of the assets they own are the units in the unit trust. That is a valuable asset. So unlike a discretionary trust where there's true separation. So protection of assets, that's probably one of the major reasons we set up a trust. Carry on a business and trading activities. We want to separate. Another asset protection is you have assets might be in your trust. You run your business in a separate entity like a company. So you separate your business assets and your actual trading business. So if the trading business goes down, at least the business assets, such as the plant and equipment and the premises, are all safe. To provide income tax benefits. Now that's always a secondary issue, isn't it? Okay, yep, we all know that. We don't have that as our dominant purpose because then the tax office might get narky at us. But in all honesty and in all practical purposes, tax benefits are great, but really they should only be a secondary issue. We need the commercial reason why we're setting up the trust and why we're using it, and then we do it in such a way that we can minimise our tax, etc. So it might be a case where we're saying, okay, the person wants to set up a business or they want to invest in a whole lot of shares. What are our options? Well, there's a trust, there's a company, they're in their own name. So we know we've got the commercial basis, what we want to do and how we want to get the income where we want to go. Now, how do we get it in the most tax effective way? And the trust might give us that. Succession planning is another one. As far as succession planning is concerned, a trust, as I said, lasts for 80 years. Now, if I own a property in my own name and I die, then it goes to whoever I leave it in my will. So if I've got a business and I die, then it goes to in my will. But if I've got the business or the property in the trust and I die, nothing changes. It's still sitting in the trust. You can only leave assets in your will to those people in respect to the assets you actually personally own. But if they're sitting in a trust, then it's whoever controls the trust, effectively owns the trust. So if I die, then you don't have to muck around going to banks and everybody else saying, oh, there's been a change in title, a change in legal ownership. No, nothing like that. It just seamlessly continues on, whoever's got control of that trust. So sometimes they're used for asset protection or for succession planning where people say, look, mum and dad say, we'll put the asset in this trust for us for the moment, but we will pass it to the kids. But we don't want to cause lots of capital gains tax if we had it in our own name and then gave it to the kids, we'd have capital gains tax. Leave it in the trust, we'll just pass control across. Those things. Some advantages of trusts, I've said asset protection, succession planning, limited liability, we've talked about the trustee, family control, providing for family members, tax advantages. I suppose if you're saying, if you've got a property which you're wanting to stay in the family forever, and if it's in the individual's name and they die, then of course it goes across without any CGT, and maybe that's in that case, yeah. We're talking mainly in a lot of cases, I suppose, about businesses and things like that, but no, that's a fair point you raise. When you look at it, if you solely want to do that on a particular asset, then it might be better just do it in individuals' names. The income tax advantages of trusts. We will look in some more detail at the taxation of trusts, but essentially, and again, I'll come back to my discretionary trust. In a trust derives income. It is taxed in the hands of the beneficiaries if the income is, for want of a better term, distributed to the beneficiaries. It's taxed in their hands. If it's not distributed to them, then essentially it's taxed in the trust. And when it's taxed in the trust, it's taxed at the top rate of 46.5%. So we don't like that. So by income splitting is by getting income in a trust, and then the trustee says, okay, I'm going to minimise tax by distributing some income to this beneficiary and some to that beneficiary. I'll distribute it to those beneficiaries who are on low rates of tax. And that way I can spread the income among a number of people and we pay lower tax overall than if it had all been derived by one person on the top rate of tax. So that's income splitting. So that's the general main advantage of having a trust from an income tax point of view. And then we have something called income streaming. Income streaming says not only do we distribute the income to people on low tax rates, we also distribute the income the trust derives different types of income, and we distribute different types of income to different beneficiaries because of their particular tax circumstances. The most classic example of this is a capital gain. If the trust derives a capital gain, if the trustee just distributes all of the income of the trust, including the capital gains, to all the beneficiaries proportionally, then each beneficiary will receive a share of the capital gain. So let's say that they distribute all the income and the capital gains to 5 beneficiaries, and each beneficiary receives 1/5 of the capital gain. But if one of those beneficiaries had a capital loss, it would be better if we distributed all the capital gain to the beneficiary of the capital loss. They offset the two and pay no tax, rather than distributing 1/5 of the capital gain to the person with the capital loss who pays no tax on the capital, their share of the gain, but the others do pay tax on their share of the capital gains. So income streaming is effectively distributing the income of the trust by type to beneficiaries so that because of the particular beneficiary's characteristics, we end up paying tax, a lower amount of tax overall. And that's what it's about. The other important thing, really important, when you want to make a beneficiary presently entitled and want to distribute, the resolutions must be done before 30 June. There's none of this waiting to get what the taxable income is. This 2 months extension that the Commissioner used to allow, it's all gone. Legally, technically, and the tax office says this now, the resolutions must be done on or before 30th of June, which makes it very difficult from a tax point of view because you don't know what the taxable income of the trust is. So that's why you'll find resolutions these days are generally on the basis distributing in percentages, etc. Very hard to distribute dollar amounts when you don't know what the total dollar amounts will be. But must be done by 30 June. That's basically imperative these days. The last thing I want to warn you about is this case called Richardson's case. And just highlights, there's some other cases there where if you get things wrong in your resolutions, you want to make sure that in Richardson's case, they thought they distributed the income one way, they had a deduction was disallowed, and all of a sudden there was an extra $700,000 of taxable income in the trust, and they're trying to argue that it didn't go to Mr. Richardson, but because of the way the resolution was worded, it did. So it's got to be careful. So if you're going to help clients with trusts, and particularly distributing income, always think, just say, well, if for some reason there is an increase in taxable income, where will it go? We want to make sure the resolution sort of, we understand that if a deduction is disallowed or something, where will that extra taxable income, or where will the extra tax have to be paid? Just keep that in mind when assisting clients with their resolutions. Okay, last warning, read the deed. Remember that one? I always said, please read the deeds.